All right. Here we go. After a little hiccup.
Let's have it, Chairwoman.
All right, here we go. 7:06 p.m. Wednesday, March 23rd. I'm going to call the JRID meeting to order. First up, to hear, consider, and approve the minutes of the regular meeting of February 23rd, 2002. I wasn't here at that meeting, so I'm going to abstain.
I'll make a motion to approve the minutes of the Wednesday, February 23rd meeting.
Thank you. Eric Caliper has a motion. Is there a second?
I'll second.
Eric Newman with a second. Okay. All in favor of the minutes, say aye.
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 Okay.
I'm going to abstain.
Any opposed? Abstain. We have two abstains, Jack Mahoney and Carolyn Trabucco.
1, 2, 3, 4, 5, 6, 7. 7 yeas. Passes.
All right. Next up, we'll move forward and go with the performance review from Vanguard.
Okay.
You, Brian.
Okay. Good evening, everyone. Good to see you. Carolyn reminded me, I thought it was in the fall, but yeah, it's longer. You said July. It was the last time in person, so good to see faces.
Wow. Huh?
Yeah. So, as far as the presentation is concerned, quick update on performance. One thing that I did build in that we'll have the continued discussion, supporting materials for the actuaries, some discussion around the estimated return on assets using Vanguard's capital market assumptions. So our latest forecast as of 12/31, probably as we get, we'll update that as of the end of March. We update our capital market forecast every quarter, but it's about a 2-month lag for our economics team to put together all the data. But anyway, it'll give you some sense, and we can update it as we get closer to the fiscal year. Why don't we get started on page 4? But I really just love jumping around, taking your questions. There's always good questions, and it's better to address it. So again, I'm going to move at a good pace, and then stop me and try to hit the big points. It goes without saying that there's been so much going on, both geopolitically with Ukraine, but also the big thing that's impacting the markets is just the Feds. They've made the first rate increase, and how much are they going to increase this year, and can the economy handle it? So what we really have here, which is odd, is that we have stocks down, but we also have bonds down because bonds are reacting to interest rate rises. So usually they're inversely related. But so you have this period where, if we look at the screen or your slides on page 4, I'll just focus on the year-to-date. This is calendar year-to-date. U.S. stocks down over 8%. Non-U.S. stocks is actually the second month in a row they've outperformed, so they're a little bit more defensive. They're only down 5.6% for some of the diversification. I'll just jump right in a little bit about the topic of Russia. We hold the total international stock index. Before the index took Russia out of the indices, before all the index providers, Russia was only 0.7% of that total international stock market index. So that would be reflected under non-U.S. stocks. But Russia is now, I think every major index provider has taken Russian securities out.
So did Vanguard then we then had to sell out all of it, so now the allocation is 0?
Well, it's out of the benchmark, and they're really reflected as worthless. But they're still held. But the Russian markets are still closed, so you can't really liquidate. I mean, I think they were, probably doing some liquidation prior, and then so the markets are still closed as far as selling any kind of Russian securities. But it's marked down as it's worthless, and same for the index.
Tomorrow they open, don't they? I think
there was a story that that Russia is going to open, and only to Russian citizens and not to international investors. So, and I read a statistics that of the Russian securities that trade, 3/4 of the trading volume or so is held by non-Russian entities. So that would just put even more pressure on it. So we'll have to see if they come back.
Hello? Are you there? Can you hear us?
Hello?
Hello?
Hi, who's speaking?
We're not muted, are we?
No.
Green light.
Kevin, is that you?
Wasn't me.
Wasn't you? Who else is on the phone?
I don't know.
Okay.
Yeah. So, yeah, the Russian securities are all
Yeah.
really marked to zero.
Hello?
Hello?
This could go on for a while.
Yeah.
I cannot get in. The Chris Brand, I cannot get in. Okay. We are having
Technical difficulties. We can hear you, but he can't hear us. Tell him to go in on the WebEx.
Develop the international and global. It wasn't emerging markets, right?
Well, so Russia is in the emerging markets index,
Okay.
but the non-U.S. stocks or the fund that's held in the portfolio is all international stocks, including emerging markets.
Mm-hmm. Okay.
Of non-U.S. markets, emerging markets are about 25% of that index.
Okay.
And you see Russia was very minute. I mean, it's really the energy companies.
Yeah, right.
Gazprom, Lukoil,
Yeah.
those stocks. It's
What
really,
did that do to the energy sector, taking that out? That must have disrupted a lot of stuff.
yeah, the energy sector is pretty small within the U.S. indices. I think it's a bit larger, but I don't know the numbers off the top of my head in the international markets.
Yeah.
But yeah,
But
of course
offsetting
the
that
pain
is the price.
is the price of
the
oil.
trading price
Yeah,
of,
right.
of the energy complex.
Yeah.
Right,
So, yeah, it's pretty crazy.
right. Should I move on or should I wait? Oh, okay.
Yeah.
I wasn't sure.
Yeah, no, we're
Okay,
but
okay.
I
Sorry
He's
for
gonna
the
call
pause.
us at 7:01.
Okay.
He's obviously calling in.
I also said we got the WebEx.
Yeah.
So, hey, we're giving people a chance to find us, and they can get in the car, they can drive over.
Mhm.
So with the funds, they hold,
Oh, yeah.
obviously they've written it down as worthless at the moment, right? And
Right.
If
So
we go out 15 years, if you never, there's eventually a regime change,
right,
and then Russia becomes back normalized to the international market.
right.
At that time it could be
They could add them.
recovery, and
Yeah, they certainly can add them back, and let's just say it's probably just a matter of time when the Russian markets open. From what I'm hearing from like your indexing, they don't have to sell right away. They'll always do it orderly. You don't have to just do it all at once. But I don't really. I mean, all I could really say is I know that they're just kind of marked as worthless. Yeah,
Right.
zero.
Right.
And Brian, if hypothetically you being Vanguard,
Right.
Were to sell what's held in Russia, would you own it through a broker-dealer in Russia? Or how would it actually be owned? Let's say it's an equity.
I mean, or how's it owned or traded? I mean, probably traded through most likely like an international broker, because I remember seeing some emails that they were suspending communications with some of the Russian brokers, etc. But where it's held, it'd still be held at one of probably the large custodian banks that we use.
So BNY Mellon would have a branch in Russia, perhaps, and
I really don't know if they have to have a branch in Russia or not. Yeah.
I'm just wondering.
It could just be registered overseas, but it might,
Okay.
Yeah.
If we could sell, we'd be selling to rubles probably anyway, and possibly get the rubles out of Russia.
Possibly. I mean, the other news story is that Russia doesn't want to be paid in dollars for oil, and now they want to be paid in rubles. So I guess there's a lot to be still developed and understood. Yeah.
you need a buyer on the other side.
You need a buyer, right? Everyone's selling. You'd have to have some international buyer that doesn't have restrictions, right? And can they handle all that volume? So I'll keep the committee updated, but that's the latest. That was the 0.7% of that total international stock back in January, but as of March 8th, which is when the FTSE index took it out, all the other indices were around that time. It's held at zero.
But as far as kind of thinking about going forward, right?
Mhm.
I mean, the first shock is always the directional shock, right? Oh my gosh, it's geopolitical shock. And then the second layer of investing is always the duration, right? How long will this last?
Right.
And then the third is going to be the dislocation that happens as a result of it all.
Right.
So from your standpoint, Vanguard's standpoint, I mean, would you recommend, based on the geopolitical background at this point, that we make any changes?
No, and I'll I'll kind of address that. I'm gonna go forward to, if you, to slide 8. This is some analysis our economics team of just past geopolitical crises. This is not COVID related, but you can see everywhere from the COVID Russian crisis to Ukraine in 2014. So there's 8 different examples up there on the slide. You know, of course, you get the sell-off, the reaction, the uncertainty, and then, you know, the second bar, the light green, is 6 months later, and the dark green to the right is 1 year later. So maybe with the exception of the Nixon impeachment hearings, but, you know, 6 to 12 months later, the markets kind of looked through it and went back to fundamentals. So that was like the second part of your question. I think the third is you know, what's the fallout, the economic piece is really oil, and, you know, how high oil stays for how long, because that kind of acts as a tax on consumers, but also on corporations. And so I don't have something in there to speak to it right now, but, you know, if oil stays between, I wrote this down, between like $95 and $105, it's $114 as of today, you know, we think, you know, the economy can still grow above trend or just above average. But if oil is 105 and above, you know, that'll be below trend economic growth, you know, lower than average, and of course higher inflation. So it's just a matter of, when you mentioned duration, it really the impact is on the oil market.
Yeah, and the curves are all super backwardated. Right.
Oh, and the commodities.
On the commodities, the oil curves, and all curves are right now so steep, so backwardated. Yeah. Which would suggest they're expecting a big economic slowdown.
Right, and so I think most major banks and indices are lowering expected growth on the back of higher oil prices. Yeah. But it's a question of how long. And our economics team will be the first, like, we don't know, we just try to create different scenarios, like I said, like, if it's in this range versus another, but, yeah.
Well, you would think, taking a look at the yield curve, you would think that there could be a recession, but you take a look at this, and, you know, what did the yield curve look like while these events were going on? Maybe that was messed up, too.
Right. And I'll come to that yield curve in just a moment, because that's such a big one. But if I go back to page 4, Jared, and just to, you know, talk about the fixed income markets, I mentioned them being negative. So this is at the end of February. Year to date, you see U.S. bonds, the Barclays, the Bloomberg Barclays aggregate, you know, the broad market. So down 3%, over 3%, just as a result of rising interest rates. Right. Now, we do hold some non-U.S. bonds, and you see, you know, the non-U.S. bonds, we do that for diversification reasons. You know, they're all different central banks. So international bonds down just slightly, you know, less than, or up versus the U.S. bonds. So the international bonds only down 3%. Since there's questions on energy, page 5, I don't always put the sector returns in there, but you see really energy, by a large shot, is the only sector on a year-to-date basis. You could see how much on a one-year basis energy is up, while all other sectors are really down, of course, on a year-to-date basis. So that's that comment of, you know, oil prices, and it's hurt something. But if you're an oil company and you're getting high prices, it's benefiting. Yeah. Well, why don't we go to page 7, since it addresses the yield curve, and you can see just how much it's moved. And when people are talking about, rates going up 25 basis points or 100 basis points, well, I think one thing that's always important to recognize is it doesn't mean that it's a parallel shift along all durations of the yield curve. So red line is where we were a year ago. I'll call it the tealish, greenish line is where we were at the end of February. And you see the biggest impact, or the biggest rise, is on the shorter end, which of course is controlled more by the Fed raising rates. So look at the 2-year. On a 1-year basis, the 2-year yield has gone up 130 basis points. And the longer term, the 10-year yield, which is referred to longer term, is still up, but but still hovering, well, it's over 2% now. This is at the end of February, but it hasn't moved as much. Usually the 10-year yield is more reflective of what, I'm just saying, people expect inflation or growth to be over the longer term. And even if you look at the Fed's plot, their dots of where the governors think rates would be in the longer term, it's still, around 2% or just over. So it's that shorter end that's really, really risen fast.
So it's going to be interesting, right, to see how the geopolitical piece legs into this, because typically in a rising rate environment, the markets are very hesitant, kind of sell off before the first rate hike, and then markets tend to do very well into the next several, into that first kind of phase of rate hikes.
After they digest it, right?
After they digest the news, right? And it isn't until they anticipate the last of the hikes, it's like, okay, it's
right, where are we? And so the Fed is talking about 6 more hikes. I think the market is still, their number is closer to 7 or 8. So we'll see. And I think where maybe you were going with the question, Jack, is this refers to the yield curve. Since the 1970s or so, when you get an inverted yield curve or the short end above the longer end, that is usually indicative of slowing growth and therefore recessions. Will it be different, this time? Who knows? But that's usually a good predictor. So we're not inverted yet, but you could see how close it is to that. Page 8, we talked about, just looking at some other geopolitical sell-offs. So why we say stay the course. And then page 9 starts to get to the performance, for both the pension and the OPEB. Not surprisingly, but the big news is that, from a fiscal year-to-date perspective, we've now drifted into negative territory. Fiscal year-to-date, even at the end of January, we were positive. But fiscal year-to-date, as you'll see on this slide, for the pension, it's down 0.38%, so just barely, but it is negative. The OPEB, what I'll just get to in a moment, it's down 1.7%. That really reflects the equity and the fixed income markets that we just talked about. Of course, we have private equity and private real estate, but they're marked quarterly, so they're not updated. They'll be updated at the end of March. The allocations at the bottom of the page, all of course within target. Just to give you an update, there's always action with the existing private equity holdings. So in February, the Lexington and Mesereau paid $832,000 of distributions. There were no calls, so we used that as well as pension payments and others to rebalance to the targets.
This would be the worst look for us, right, on the 1, 3, and 5 year, because this would have picked up February.
This picked up February.
This is pre-COVID, right? If you think about the market, absolutely collapsing in March, right? And then so this would.
Yeah, but that was 2020. Yeah. Yep. Yes. Yeah. If that's what you mean, incorporating COVID and this.
Incorporating COVID and this, yeah.
Yeah, that'd be, certainly in the 3-year number.
Right.
So no more comments on the performance on this particular slide. Page 11, so I do get information from Principal. It's not reflected in here because talking about, it's a lag, but just to give you an update since I have it from Principal, the private real estate, their fund, on a net basis, the 1-year return ending December was 25.99%. So really strong, just as real estate came back. I think, Tommy, you had asked some questions about that, and, what's doing well, like, the industrial sector, I think the warehousing, strongest sector by far, multifamily behind that, and then, retail and office, kind of the laggards within the private real estate market. So it doesn't reflect in the performance report because it's not updated, and it's not, I guess, we haven't gotten the official report from Principal. Page 13, I already gave you the number, but this is just looking at the OPEB, remembering that the OPEB has a slightly more risk in it with as far as heavy equity allocation, more of a 70-30 portfolio, and so fiscal year to date down 1.7%. So not surprising to see it down a little bit more than the pension. We don't really have any cash flows in the OPEB plan.
And we do have a modest, it looks like, capital allocation into private equity.
Yeah, the first
Yeah,
capital
the
was
first capital
called
call.
in December, just to kick off the fund, so that, the capital was called in December. There haven't been any other calls from the Vanguard HarborVest Fund. It was just that initial call in December to start the 2021 vintage.
Okay.
Mm-hmm.
Just a little, we have up for our next month and the month after on our annual kind of schedule, a closer look at the alternatives.
Okay.
Would it make sense? Does anyone want to, we can take them in order. Should we have principal in, kind of thinking about who would be the most topical, apropos to see if they could come and present to us in April?
I think so. I think that's a good idea, given where they just are with the reporting, kind of, we already have a good sense of how the year ended, and that's, I think that would make sense, unless there's other opinions from the JREB.
Mm-hmm. Principals for April?
Sounds great.
Jack, what do you think? And
Sure.
And then for May, because we set aside kind of 2 months to go through and review the alt book. Mesereau, Lexington, last time we had them in was a year and a half.
It was probably about a year ago. I think it was in the spring. I can go back and look.
Remember?
But they both presented.
Okay.
I think Mesereau took a little bit more than their allotted time, if I remember. But, because we gave them 10 or 15 minutes each.
Yeah.
But
Yeah.
I know he was super passionate. That I was just remembering the dialogue.
Okay. So let me see if we can
Okay.
bring them in.
Okay.
And we've recently had the update from HarborVest, obviously,
Right.
because of the allocation and the diligence we did around it.
Right.
So I think we're okay to give them a pass for,
Sure, and there was one document that I'd forwarded, maybe, the annual report, and it had some case studies, but I don't think I've sent it to the old board, maybe you, Eric, and maybe two Erics, yeah. So page 18 was where I was just going to, show some analysis with respect to our forward-looking estimate of what we think that the plan would return over a 30-year basis. We do it on a 30-year basis because that's usually what the actuary uses. We could do all different time periods, but we report on, what the actuary uses.
Brian, what page you said?
That's 18. So just a recap of how we do this. You see the policy targets for each of the asset classes, just the policy target. The numbers to the right of those policy targets are our expected returns for those asset classes. And what the numbers just mean is, I'll focus on the 50th, that's just the median. The median expected return, let's say for U.S. equities over the next 30 years, 5.2%. But we provide a distribution because, you can't expect to hit that midpoint. So, taking into consideration our forecast for the asset classes, your weights, it's not a simple average because there's different correlations between the asset classes, which is at the bottom of the page. But right in the middle says, okay, here's the portfolio return distribution for the pension plan. So at the median or at the 50th percentile, we expect 6.14% return based on the asset allocation in the forecast. And I'll call it up to the 75th percentile. Some actuaries will go beyond that, but a high of 6.79% as far as a range. Right now, the town is at 6.9. I'll just provide some additional context and color. I think this will be also a low point as far as market forecast, because this is as of December. So equity markets were so strong, valuations were really rich in the equity markets. Fixed income, just not reflecting the increase in yields, so yields are very low. So when we update this in March, I don't know what the rest of March will do, but I would expect that these numbers would certainly shift, but towards the higher side. Will it get to 6.9? I definitely doubt it, but I think it'll be a little bit more rosy than what we have here. So that's why we'll update it again for the March, once we have March
Yeah,
forecast.
and we've got it on the agenda for July,
Mhm.
when we would discuss the discount.
Right.
So maybe we want one more look at it too again June.
Exactly,
To
exactly.
get a sense about maybe if we want to adjust the discount rate.
Yeah, so even in July, we wouldn't have forecasts for the asset classes as of June 30th. We'd still have the March, but,
Okay.
yeah.
You can watch it on a lag.
Just,
I'm just thinking, what
Mhm.
real good is this if it just changes every time the market shifts?
well, it doesn't change materially, unless you have big moves like you did 2 years ago with COVID. But it's always it's gonna move a little bit based on what the valuations in the markets or interest rates are doing. We've seen, and those have been pretty wide since December.
Okay.
You saw what's happened with rates, and you saw, U.S. markets, they're only down 6% now, a little bit better from where we ended in February, but it'll shift, but not materially.
So it's a good indicator?
It is a good indicator, yeah.
Okay.
And the board will decide, right, whether or not they wanna be proactive or just kind of wait and see. Right, it's not something that we have changed every year. We take kind of a very measured approach to it.
Mhm. Yeah, and gradual,
No. And we changed that calendar,
Yes, you did.
so that everyone surprised the town.
It caused a little chaos that
A little
one.
chaos that day.
I'd say most states, counties, companies, do a gradual approach, whether it's up and on the downside. And, the trend has been down given all the topics we discussed around high valuations, low rates, but, yeah.
So, keep an eye on it. Thank
We
you
will.
for putting that slide in.
Yeah, and the next page is just for the OPEB, because it's a different allocation, and so that's a little bit higher. You see at the midpoint, 6.58% for the OPEB plan.
Right, look at that.
I have, starting on page 22, market outlook slide, but we already touched about this, and this is already old because of everything going on. I mean, we update this monthly as far as what we think rates, inflation, et cetera, will do, but it's just shifting so much that I just feel like it's already old here. So I think the things that we were thinking would affect is what we talked about, and the wild card is oil. And oil is related to inflation and how much the Fed hikes. So again, the Fed has targeted 6 more hikes, or kind of indicated that, but the market is still expecting maybe 7 or 8. I guess the thing to take into consideration, even with say 6 or 7 hikes and get to 2.5%, real rates after you factor in inflation are still negative. So over the long term, we think raising rates are good for investors, but there's some short-term pain to fixed income. See if I've left any other notes out. No, I think we've talked about most of the current events and the historical. Any other general questions top of mind? Yeah.
I mean, with the allocations the big decision we would make is if we wanted to make a change to the allocations, and
right.
You're not counseling that, and we're not reading that, and I think we hold.
I think the biggest thing is to always consider the allocation with respect to the discount rate, right? So I think those are the levers. Like if to bring the discount rate down, in the future or gradually, then I think this allocation is, still suitable. If you're like, we want to hold that discount rate firm, then it's, well, okay, how do we position the portfolio to try to hit that discount rate? But recognizing that means taking more risk into the portfolio, which is mainly, I'll call it equity risk. Yeah. But I don't see the need to make any kind of decision right now. Right? No, by any means. But those are the levers, especially with public plans. Is you have your discount rate that determines how much you need to contribute, and I think you'll be in a good spot because of the last fiscal year of how much it was over the long-term return. So it might give you some wiggle room that the contributions, even if you brought down the discount rate, are not that much because of how big the last year's gain was.
So on OPEB,
Mm-hmm.
as a 70-30 portfolio, and
Yeah.
the 75 million, does that shift at some point? Is this number, is this the 75 million?
Does the allocation
Does the
shift?
allocation shift? Or not for a while?
No, I mean, it's not on any kind of predetermined glide path to shift the allocation. I think it's more of a discussion there. The OPEB plans, I have to go back, I don't remember, they're not as well-funded as the pension plan.
Right.
And that's not saying that most OPEBs are not.
Right.
And they were only started in the early 2000s or so. So I think your OPEB plan is actually better than
Most.
other states, most in Connecticut or nationwide, even if 40% seems so dire. So I think the allocation is more of, higher risk to help grow that funded status over time, but the allocations won't change just on a dollar value.
Okay.
It's more with respect to that discount rate
Okay.
and the funded status.
Yeah.
And
Yeah.
OPEB doesn't make distributions out,
Right.
Right.
just in.
But, the pension plan is making about $2.5 million or so in distributions a month, to pay beneficiaries. That's roughly speaking, $2.5 million.
Okay.
But the OPEB plan does not have any distributions, going out.
There's just growing the assets at this point versus, okay, we want to
Right.
get cash coming in, like in a pension plan.
Right.
We gotta make monthly
Payment.
payments.
Right.
So it's good to have
Yeah,
other,
a lot of OPEB plans, I'm not an expert, but it's more of like a pay-as-you-go, with respect to, growing that corpus.
Yeah, it's like being a 26-year-old.
Yes.
Contributing to your retirement account, right? You can be a little more aggressive, in your allocations,
Mm-hmm.
unlike the pensions, which are a little older,
Mm-hmm, mm-hmm.
so, but healthy. All right, well, we gotta watch.
Does that help address
Yeah, it
it, or
does.
anything else, with respect to that?
No.
Okay.
When do you think the fixed income side of the allocation will benefit from rising rates? Do you think we have to go through a period of time, before we begin to kind of catch that in the sale?
I don't think so, but it's just a guess at this point, to be honest, only because you see how much the yield curve has already moved,
Yeah.
right? So you say, okay, is a lot of this already priced in? We're down 3%. We're probably down more if you take in the fourth quarter. So the curve has already moved ahead of the Fed rates. So maybe by the end of the year, there could still be a positive return given the higher interest.
I don't know.
I don't know. I mean, it might be a stretch, but, the fixed income, investors start benefiting from the higher interest rates. We didn't talk about it here, but we don't have any. We've talked about having maybe an overweight to investment grade bonds. So credit spreads, so bonds held by corporations have started to widen, but nothing like they didn't widen anything like 2008 or COVID. So it's not any big stress in the economy, but credit spreads are starting to widen, again, to give investors maybe some yield over treasuries.
And treasuries are widening too, so the combined effect.
Yeah, treasury yields are going up.
Right.
But as far as if you were, picture is better. Jack, could you go to, say, page 6? So you can go into different segments of the fixed income market to try to get additional yield over government securities. And the two main ones, I'm going to call the two main ones, be corporate bonds or high yield bonds, to try to get some additional yield. So on the left-hand side, you can see this is just the indices defined by credit quality. So, treasuries are down 2.5, government securities, but you see investment grade credit on a year-to-date basis, it's now down 5%. Investment grade meaning high quality. So spreads have widened, meaning so yields have gone up even more, and so that's brought investment grade credit down more than government. And then high yield spreads haven't really risen all that. I mean, they've widened too, but you could see they're only down 3.7. So they're not seeing any pickup in the expected defaults in high yield. High yield is referred to as junk, and therefore that really moves in a very bad economic environment because, some of these companies will go belly up. So there's no stress in the high yield market, but spreads are widening through the different segments of the fixed income market.
So if you're a treasurer, you're facing increasing treasury yields as well as increased spreads.
Yes. And so say for, our fixed income group, and they do manage some active fixed income, they're starting to see some of the corporate credits to be more attractive to go into. They really didn't have any kind of overweight there because they just didn't feel like you were getting paid to hold it. But it's not still looking attractive because they haven't widened all too much.
So given that, right, would it make sense to consider, right now we have one master allocation, right, to the whole kind of fixed income market?
Yes.
Would it make sense to look at, segmenting that out?
I think so. We do that for clients, and with respect to that, we mostly advocate for an overweight to the investment grade credit because we see that over time it's a compensated risk. Corporate bonds, maybe I could bring it to another slide, tend to over longer periods of time just earn more than Treasury, so it's a compensated risk. But before this was all happening, credit spreads, like, you look on a distribution, were like in the 10th decile or like all-time tights because there was that search from yield. Everyone was trying to get some. So yields were like at 20 or 30-year tights, meaning, and it just wasn't attractive. And so, we discussed it about a year, maybe even 2 years ago, and we felt that way as well. And so, but there might be a time, not to tactically chase it, but as it gets more attractive, to get some more yield into the portfolio or some return. So yes, I think.
Yeah. Maybe for next meeting, next month, if you could kind of give us a little deeper lay of the land and give us some ideas and some options of what else might be out there. It would. Right.
Can I give you one last step? Page 16, Jared. I include this because this is just the indices over longer periods of time. Back probably. Yeah, here we go. Thank you. So look on the. Okay, you have in the middle of the page it says fixed income domestic, and the first index right under that says Bloomberg U.S. aggregate. That's the broad fixed income market. So go all the way to the right. Over 10 years, you get 2.5% from the fixed income market. So not much. But if you go down like 3 lines, you'll see Bloomberg U.S. credit 5 to 10 year, and that one is more the one to look at because that's measuring how long the maturity of duration is. The duration of the U.S. aggregate is about 6.5 years. So if you look at equivalent maturity of corporate bonds, so you look at that credit 5 to 10 years, and you go all the way to the right, 4%. So you've earned 1.5% more than the broad fixed income market by taking on some additional credit risk. So where we advocate is staying in high quality and not really reaching to the high yield market. The high yield market is still fixed income, but it tends to behave more like equities. So high yield is just a riskier part of the fixed income market. We don't think that's more of a comparison. We think high yield is more akin to reaching for return, and therefore you would take that or fund it from equities.
So Brian, we are in equities already. So
you're already in equities.
So I guess the point is that high yield, from a tactical sense, doesn't make sense spread-wise. So we had a low decile position in terms of spread. Is that the issue?
Well, yeah, you've been at low decile spread any part of the fixed income market, mortgage backs, credit, high yield, because investors were just need or looking for any kind of yield with interest rates at zero. So
you think high grade might be more attractive?
Well, we just think of, from an asset allocation perspective, if you were going to move to investment grade corporate, that's still fixed income. But if you were going to ever go into high yield to get some additional return, you would really say, well, where are we gonna take that allocation? If we're gonna put 10% into high yield, where would we take that from? And that would be more of a decision to take it from, we believe, from equity. Because it becomes much more volatile, and I could show some charts on that, like, you can have big drawdowns in high yield in double digits. So is that really fixed income? Fixed income is supposed to be the ballast in your portfolio, protection for down markets. Not this year, but, in general.
But the high grade corporate.
Correct.
Could be an interesting place to be over the next
To get some
5
additional.
years or so, right?
I thought I heard that.
Yes,
That's what
yes.
I think that's a great idea.
Yes.
That's what really, that's what's attractive to me, is maybe looking at the corporate.
That at some point, correct,
And
yeah.
taking that as a sub-allocation with the bigger allocation.
Right, we could take
Kind of
away,
overweight.
we could take away from the total bond market index, and we could
And
put some
Put
toward
them into the,
high,
into the corporate.
investment grade.
Investment grade.
Investment grade, yeah.
Yeah, I would love to see what that might look like, yeah.
Yeah, right now, if you ran it, with the 1231 allocations, you might show a couple basis points above, but yes, we'll look at that.
Yeah, and think about it in light of the backdrop that you just presented to us, right? We're in a rising rate environment, we have inflation issues, you've got some geopolitical, headwind and noise, and they've all sold off so much.
Yeah. Well, we say they've sold off, but not a ton, But yes, but they have sold off, yes.
They've sold off.
As you could see in the returns, yeah.
Yeah.
They're down more than treasuries, yeah. So,
Yeah.
I'll do that for
Yeah.
this committee, yeah.
Yes, please. Okay.
Do corporates tend to be floating rate, or is that more in the others, or private?
I think it's more,
Like the
I
fixed-
think it's more fixed income, think about the big
Big ones, right,
corporations,
big
the
corporations.
GEs, or, the
Yeah,
Exxons,
they're
like,
one rate.
and
Right.
they've all been extending maturities because,
They
if you're a
borrow.
CFO of a company and you're like, I can borrow 5 or 10 or 30 years at, zero or such a spread, yeah, so corporations have been loading up on debt in this environment, or extending the maturity as well. Why wouldn't you if you were the CFO of any major company, yeah?
Wouldn't you?
Yeah.
And you watch CNN, you think, maybe things are gonna get crappy sometime soon. Maybe issuing might not be as, attractive to me in 6 months as it is right now.
Right. Yeah, they try to lock it in.
Well, good. Any other questions? All right, should we move on?
I want to ask you a question about that, Brian.
Yes.
Supposing an allocation of $10 million or $50 million, whatever the number is, were segregated into U.S. corporate debt, kind of to your question.
Yes.
How would that be implemented in this fund structure?
Right.
Individual names? You have a fund that
Fund.
you're basically rolling out ahead of a 5-year duration or something?
Yes. That latter point. It would be into fund, not buying individual bonds.
And
So.
what sort of diversification are you going to get in there? How many names?
Yeah, maybe while you're doing other business, I could look it up, but you're probably getting, I'm going to try to go off, remember, like 1,500 names, corporate bonds, so very diversified.
Millions of, okay.
Yeah,
$1 million fund.
so for instance, the Vanguard Investment Grade Fund, yeah, I would say, 1,500 or so securities, and you could still only do that at 10 basis points, in a very low-cost way, and that's one of the bigger fixed income funds, from an actively managed perspective at Vanguard, just for, and that has a duration around 6 years, yes,
Okay.
all high quality, yeah. So implemented through a fund.
And do you guys, construct funds similar to the Barclays indices, or?
Well, would always be measured to some indice, like for instance, the intermediate grade investment grade fund would be, the intermediate term investment grade would use that benchmark, the Bloomberg U.S. Credit 5 to 10 year. You can then also add in a short term investment grade fund, and that has more of a duration of 2 to 3 years.
Is Bloomberg the old Barclays, or?
Yes.
It is, okay.
Yeah, that's why it's called Bloomberg Barclays. Used to be called the Barclays Ag.
Right.
I don't know if it was 3 or so years ago, 4 years ago, Bloomberg bought it.
Got it.
And so now they're called Bloomberg Barclays USA. Yeah.
I'm showing my age.
Yeah.
I'm gonna say Lehman in a second.
Yeah, right. So,
All right, good. Well, we'll get some thoughts for next month, I think. Let's take a look at it. All right. If not, let's move forward. Okay, so we've got the, IPS review, right? I'm guessing that's the,
IPS, sorry.
that's the IPS review.
Oops.
Okay, so this is the investment policy statement, and we do have kind of a guideline that we're supposed to adhere to, which is that we review it and twice a year, and if we're not making changes to it, we just pass it as is. If we want to make changes to it, we can make changes to it. So this is the third month or so we've kind of put this up here. And so I would welcome any thought to any changes in this iteration, whether or not we want to. I think the allocations, right? We've talked about the allocations. The allocations are the kind of the important element of the IPS, and the allocations are likely to stay the same. But just thinking about it a little more holistically, is there anything that stands out that anyone would like to put forth to amend or change?
Well, could I just address a housekeeping issue? I read it this afternoon, I thought it said it needs to be reviewed biannually, which doesn't mean we can't do it more frequently.
No, it's twice a year.
Twice a year.
Yeah, we're supposed to,
Okay, maybe I read an old version.
I don't remember the term.
I don't know.
It says at least biannually,
Yeah, isn't it biannual twice a year?
semi-annual.
Semi-annual.
So I'm just saying the pressure's on,
on.
if we choose to do it, obviously we can choose. So I'm just saying, as a housekeeping matter, I don't think we have to.
We don't have to. So we can hold out.
But
last time we went through it word for word, and there was a lot of like wordsmithing and.
Yes, we did.
6 months ago or so, or a year ago.
A little more than that. I think we did the full.
Yeah, I think it was in the fall.
We inserted some ESG language and.
And the allocation changes?
With the allocation changes, right.
Okay, all right.
So I looked it up, 2,000 bonds in the intermediate term investment grade fund. So you're talking about 2,000 bonds to get that diversification.
All right.
Carol, I have a couple questions about the
Yeah.
IPS, if this is the right.
We can do it,
funding
absolutely.
forum. One thing, this may seem like a really small point, and it probably is, but it said we can do, short sales of fixed income, which kind of surprised me. Have we ever done that? Do we want that? Is that a real possibility of something we might do?
I don't think we've ever, no.
It surprised me to see it.
Yeah.
I would just suggest we not have it in there
Yep.
if we don't realistically
Strike
expect
that.
to use it.
Tom, which one are you looking at? The one that's online or the one that was sent out to the members?
It's dated September 21st, final and approved. I'm not
No,
sure.
that's then,
Yeah, that would,
would that be the one?
that's it, that's the most recent one. You know, we, I don't recall that we've ever
Well, not
changed
certainly I've been
anything
here, I don't,
short
Like I
selling
said, I think
of
it's a small
fixed income.
point,
Yeah,
but
we should
we're not
remove it,
gonna
I
do
think
it.
makes a lot of sense.
Seems like
Yep.
a weird thing to, seems like an inappropriate thing for a town to be thinking about
Correct.
doing. But maybe I'm.
Unless it's, right now, we're in funds, right, Vanguard funds. If you had SMEs, where you have an asset allocated to a bond manager, who's then actively managing a group of $20 million within a separate account, they would be shorting it, technically, potentially.
Like I said, I'm not against it, it just seems an odd thing.
But as within the, going into long only pretty much funds,
Right.
That there might be a fund out there that says, okay, we could go either way within a particular corporate fund or whatever fund.
yeah, you'd have to have some, actively managed fixed income fund that is, like the multi-strategy that can, do anything to get total return. Like a PIMCO comes to mind and, use derivatives, just to get return. But yeah, it wouldn't even be standard in like an,
I think having it in there in the event that the monies were in a fund where the manager chose for some reason to hedge a position with a short position, you've covered the base. So the fact that it's there, I don't think it should be deleted. If it's never used, that's okay. Why delete something that, gives you more latitude if in such you choose to do that?
Yeah, it may have been in there when we were interviewing like active bond portfolio managers. Maybe that was one of the, things they would look at, when they were looking at bringing somebody in, and they'd be like, well, that's something that we may want to do, and you'd limit them from, before the board. So you throw a very wide net of what you could do as an active bond manager, that you wouldn't limit them.
Is there a way just to flag this so that if we interview managers going forward, we actually think about whether this is a power we want to give people? I'm thinking about Orange County derivatives, and, they probably thought they were acting defensively and doing prudent things, and they lost, hundreds of millions of dollars, whatever the number was at Orange County. I mean, they shouldn't have been playing games with derivatives.
Yeah.
And maybe they didn't even know they were. Maybe, I don't remember the details, but it just seems odd to have it in IPS if we don't realistically expect to use it. So can we just flag it for future
managers?
Yeah, monitor.
yeah, I'll look at I don't remember the wording as well, but.
It's on page 13, by the way, that helps. It's the very last line on the page.
I think now that we're with mostly passive management, I think it's, to Eric's point, probably move at this point, but Bruce's point, I mean, maybe just keep it in there.
Those are days pre when we hired CFOs yourselves to manage the money.
And I swear I have only one other point.
Okay.
We say that we look to the 3 to 5 year record of prospective managers, and I wondered if we should pair that with a longer term. It just seems 3 to 5 years is fairly short. Expect above peer performance and to be measuring. It just seems like if we had a 10-year metric as well, that we could defer to the longer one if the manager actually had a 10-year record. I don't presume it's always the case.
You could do that. I mean, you could put something of language like at least, 3 to 5, and then it gives you to say, we think looking at 10 years,
I went through it line by line, those
right.
are the two things that jumped out at me.
That's great. Okay. Yep. Happy to flag those two, and, come back with it next month, right, with some wording in it. That's all right, unless we want to move forward and, approve it with those changes. I don't know if we've landed on a spot, though, if we keep the short selling of bonds in it, and we watch, or if we wait till next.
I don't think there's any harm in keeping it as of this meeting, but,
I think flagging it is just for going forward purposes. If in a year we look back and say, this hasn't come up, nobody's mentioned it, we've asked about it repeatedly. I personally would be against giving powers to managers that we don't expect to ever see used, and then all of a sudden we get surprised because we decided, this is part of my business plan. It's in your IPS. I mean, I wouldn't expect us to do this.
Okay, so we'll monitor that, but if you want to make a motion to change the language to include to include at least 3 to 5 years, up to 10 years. Do you want to propose me some language?
I move to add the words "at least" to the 3 to 5 year metric on page 8.
Okay, so do we have a second? Calver will second. Okay, any additional discussion?
At least 3 to 5 years, but we're not going to do...
At least 3 to 5 years.
We're not going to go up to 10.
Nope, just say at least 3 to 5. Okay? All in favor? Aye? Aye. Aye.
Aye.
Okay. Opposed? Or abstain? Nope. Okay, motion carries unanimously. We'll make that change. There it is. Thank you. All right, let's move on. Item 5, old business. Let's talk about the RFP for pension payments processing.
2 things. We're still working on that through purchasing, so we'll get that out soon. The second piece that's not listed on here has to do with the contract with Milliman for pension administration services, and I wanted to bring potentially an issue to the attention of the board. So part of the contract, I know we talked about, in hiring them, that we wanted to give ourselves some flexibility to get out. You know, if things weren't working out a year and a half from now, that we could let them go and, you know, pursue a different course or another company or whatever. So as we're going through the contract, there's effectively kind of keeps us with them for about 60 months. If we choose to terminate early, then we have to pay a pro rata amount of the remaining time that's left on the contract for their whatever their annual fee is. And the reason for that, I had a conversation with them and asked them if they're, you know, willing to move on that at all, and they're going to look into it, but I don't think there's going to be any huge movements. So, you know, maybe they could get the time down, I don't know, maybe they could get it down to 48 months, or they can limit the, you know, the amount that we would have to pay out over the remaining years. But I don't expect, it doesn't sound like there would be a whole lot of movement there. Now, there is still, if it's for cause, we can get rid of them, and you know, assuming that it went our way, then we wouldn't have to pay out their remaining piece. But I guess, Mike, the question that occurred to me was, what's the board's threshold? Is it for cause that we would get rid of them, or is it something lower that you had in mind, that if we were to discontinue and terminate the contract, that we may be subject to continuing to pay them?
Could I ask, does cause include negligence? I assume it does.
You know, if I remember our conversation, that was one of the words that he used.
I mean, it seems unimaginable we'd want to fire them if they were doing a good job.
Yeah, and I don't know if it's specifically mentioned in here.
Why do they have such a long?
It says for.
Installation?
I'll touch on that in 1 second. So, for any reason other than Milliman's failure to perform its duties under this agreement in a competent and timely manner is the phrase that they use. So the reason that they do it is because while we pay them, it's $15,000 or something like that for the initial, I'll say, setup, there's a lot more on the front end that they have to do. And they basically kind of amortize it over a 5-year period of billing to us, rather than charging us up front.
And how much is that amount? Like beyond the $15,000?
Yeah, so, and we haven't gotten to a final price in the contract yet, so we need to take a look at that.
What's the range? What are we talking?
When we first looked at it, I believe that we were looking at something between like $120 and $140 a year is what I have in my head.
Yep.
5-year contract, is that correct?
So it's,
60 months?
you know, we can, like I said, we can terminate whenever we want, but this provision in the contract would tie us in for 60 years, for 60 months.
Yeah, I'm comfortable with 50 years.
And we would, that we would have to pay the prorated amount remaining on the contract.
There are other contracts, when it's like every couple of years you have to go for an RFP. What's the duration left on that? Because at some point we're going to have to go for an RFP prior to their regular ordinances, and it's going to be a disconnect because they've already been providing us several years of this, and now we're going into.
You mean for the actuary?
Actuary, yeah.
No, we don't have that like an auditor.
Oh, okay.
No, we have the Hooker and Holcomb relationship. The pension funds had the Hooker and Holcomb relationship for 20 years.
Yeah.
Okay.
We don't, and you don't have a best practice going on the way that you do with your auditor.
Okay,
So let's say we're with them for 5+ years.
Yep.
Then does that go away?
Yeah, right. We can terminate after that.
So after that,
Yeah.
fine, it goes back to normal
Right.
terms, whatever, 30 days or, you know, whatever it is.
Yeah. Yeah.
So is that standard for this type of?
It's standard, yeah, that's my understanding. For this type of service, that's the case. Because there's so much work that's done up front.
Okay.
Yeah.
I would
say
that
so.
we would be terminating them without cause.
Right.
I mean, 5 years is a long time, but I mean, this is a big deal that we're going through.
It is,
So,
yeah.
And I would probably think there'd probably be if we were unhappy with their performance, there'd be a paper trail of correspondence back and forth,
Right.
issuing how, the town's not happy, the employees are not happy, the pensioners are not happy. And
Right.
it would have to
Fix
be
it.
basis.
Right, how do we fix it?
Right.
Is there a connect, we use them as an actuary as well, right?
Yes, we just moved on to them, we just switched last year.
So is there any issue with having them being, what is it called, this role?
It's a pension administration.
Pension administrator as well as an actuary for us?
Yeah. Is there any?
No, you don't have a conflict.
No.
They're-
So if we could fire one
they're not-
side and
yeah.
keep the other side, and
Definitely.
everybody's
You can.
so happy.
Yeah.
You can.
Yeah.
The pension administrator, because so much of the records here, it's an old plan, a lot of the records are still kept on paper. We want to move them into an electronic, format and out of the old, in whatever systems we do have.
Right.
The motivation seems awesome. I'm just wondering if there's an issue. It's not like the answer is no.
No,
We've been having them.
no, I think when Jared called me about this yesterday, I mean, it was just a surprise. He just found that in the terms of the contract and, we decided to just bring it forth here to talk about it.
Yeah, and I would have not said anything, but I know that for the board, it was, you were looking for some flexibility when we first signed on in
Right.
case there were issues with them, so.
So the worst case is something bad happens immediately. It's not because of Milliman's bad performance, it's some other thing that we come across. We fire them and we owe $600K.
We owe
To them.
something, yeah.
So the funds get hit for $600,000.
And it's gonna take us 2 years to unwind it and find another actuary to do that
Yeah.
service anyway, and.
Half of $600K or something.
Right,
Right.
and let's assume we at least go 2 years
2 years,
before there's
right.
an issue.
Right.
That's right.
So that downside is $200 to $300K or something like
Yeah.
that. Okay.
I would say so.
Okay.
It's being prorated, so what this piece is,
Right.
gets less and less as you go out.
It's not a big
right.
concern, right?
And then what they don't
I
want,
think
if there
so.
was an issue, was us going to other towns talking about, how poorly they performed, sizable legal action.
So it sounds
Probably to me isn't a big deal.
I have no concerns about, contracting with them, it's nothing like that. Again, it was just because wanted to bring it to the board.
It sounds like as an operational matter, and Jared, I think this is your area, if I understand correctly, we should be very on top of any complaints that start coming in, and we should be documenting them and going to Millman and saying, hey, we've heard from Josephine or Joe Schmidt that this is not going well.
Yeah.
What are you doing to fix the problem? So there's a paper trail. So that sounds like operationally something that would.
Yeah,
Yeah.
and either between, my department or HR, probably more in the HR department.
All right, so it seems like a priority, making sure HR understands.
Yep,
Yeah.
I think that's a great idea. And that will help in the event we do come down the pike and we're upset with something doesn't work.
Okay.
Okay?
Yep. We'll
Okay.
move forward then.
Then we move forward.
Thank you.
Thank you for bringing it up.
Yeah.
Thank you for flagging it and bringing it up. So, do we have any other old business?
No.
Okay?
Charlie, can I hear something? I was talking to Brian today, the other day about something, and he mentioned that he had talked to you, regarding some sort of liability issue.
Yes. You wanna talk about this?
Yeah, I'd like to
thing?
know
So, I can inform you, I don't think we have any member of the public on, and I don't have to go, do I have to go into exec session?
I don't know.
It's not on the agenda.
Depends on.
Is it about potential lawsuit or something?
Yes,
You probably should go
Yeah.
out there.
Then I would better,
Okay.
we should do that.
okay.
But you didn't,
I didn't notice it ahead of time,
Yeah.
so you can't go into an executive session.
so I can't go into executive session.
You gotta put it down for next month, or call a special meeting.
We don't have to discuss it, it's just I'll speak to you.
Are you
Yeah.
sure? Because I've done that on the Board of Finance. I've gone into executive session.
You have, right, in the midst of it.
If
Yeah.
something comes up,
Board of Ed has done that too, that we have to discuss,
now, it could be we did it wrong,
right?
but I'm just saying.
Hey, I'm more than happy to call us into an executive session, to have the discussion.
Right, we did
We've done that.
it for the Board of Selectmen on an issue.
I know
that
for
came
the
up
Board of
late in
Finance,
budget.
something comes up, we
Okay.
gotta go.
All right,
But,
okay,
but we've done it, I'm not saying we've done it, that's correct.
understand,
But we've done it.
understand,
So if somebody wants to make a motion to go into an executive session, you're gonna make a
I will
motion?
move, as we go into executive
So
session.
we'll also need to,
I have to stop recording.
stop recording,
Yep.
right?
Do we have a second on the motion?
I'll second the motion, Eric Callender.
All in favor?
Aye, unanimous.
At 8:10.
if you ever need me to leave, then I can, I never take offense. When
Generally, yes.
Yes.
if something
I think
leaves
that
and
makes
I
sense.
should go,
Would you
then
mind,
yeah, no, not at all.
Hold on, I gotta figure out, I gotta get my,
Just turn
The
this down.
OCIO part and parcel to this, Chairman?
No, OPO is not part and parcel.
I don't think, we don't need Brian back, do we?
We don't need
No.
to do that. Brian can go if you like.
Oh, it's just a matter of,
Thank
if
you,
you
Brian.
need to ever kick me out, then kick me out, and don't.
Pull your
Yeah.
pockets for some of that candy.
Right, yeah. All right.
Whatever ride you got.
Okay.
Help you.
All right, we
I'm gonna
are,
make a note that there's,
yep, coming out of executive session,
At 8:46
PM. We'll note that no votes were taken during executive session.
perfect.
All right, with that, could we have a motion to adjourn?
Make a motion to adjourn.
Eric Newman, second?
Well, so.
Second? All right, all in favor? I think that's an easy one. Thank you. Good.
This ends the recording of the Joint Retirement Investment Board meeting held on March 23rd, beginning at 7 o'clock. My name is Christine Bacamazzo. I am the recording secretary.